The Richest Man in Babylon, Rich Dad, Poor Dad, and Think and Grow Rich are bestsellers that have become iconic, alongside the works of Tony Robbins, Benjamin Graham, and John Bogle. What unites them? Simple language that is accessible to everyone. They rarely feature complex terms or scientific calculations, making them easy to digest. But here's the paradox. Despite this, the information in such books is not always supported by real data and critical analysis. In 2022, Yale University finance professor James Choi published a study comparing recommendations from 50 popular financial books with the opinions of the academic community. Financial books often recommend saving 10 to 15% of income each month. This is convenient. You get paid, you save 15%. The key is to develop a habit. But economists believe that the savings rate should depend on age and circumstances. Young people can afford to save less as their income will grow over time. In middle age, when incomes are at their peak, savings should be maximized. And in retirement, you can spend the accumulated funds. Many books advise spending 4% of capital annually in retirement. This is the 4% rule. However, choosing too aggressive a rate can deplete your capital prematurely. One alternative is annuities, which guarantee monthly payments for the rest of your life. Some books recommend creating separate portfolios for different goals. This approach is based on a cognitive bias known as mental accounting. But from an economic perspective, capital is a single portfolio, and only that should concern you. Dividing it into separate baskets does not reduce risk or increase returns. Both scientific approaches and popular books agree that young investors should hold more stocks and increase the proportion of bonds with age. However, the reasons for these recommendations differ. Economists believe that human capital in youth can be considered as bonds, so one can afford to take more risks early in life. Financial theory recommends avoiding dividend payments as they do not create value and are taxed. However, many books do not take this into account. Dividends are simply a transfer of money from the company to your account, which does not make you richer. Most books advise investing in global stocks rather than just US stocks. However, the recommended proportions are significantly lower than market proportions. Authors often do not explain why they suggest a large bias towards US stocks, despite the fact that the returns on stocks of multinational companies correlate with their domestic market. Some books recommend starting to invest even with outstanding loans, ignoring their interest rates. However, this is odd from a mathematical perspective. Why invest in an instrument with an expected return of 7% if you have a loan at 10%? It's better to pay off the loan first. Many personal finance books, such as Robert Kiyosaki's Rich Dad, Poor Dad, actively promote real estate investment as a reliable way to build wealth. They often highlight the benefits of property ownership, such as stable rental income and the potential for asset appreciation. Academic research shows that real estate investment is not always the best option. Real estate requires significant initial costs, regular maintenance and management, and can be less liquid compared to other investment tools. Some studies suggest that diversified portfolios of stocks and bonds can offer higher returns with lower risks. Both popular literature and academic research agree on one point. Passive investing through index funds is the best approach for most individual investors. Popular financial advice may differ from standard economic theory, but it has its strengths. The advice is simple to apply and takes into account the real difficulties people face. However, not all recommendations from popular books are supported by academic theory. If you want to build your initial capital but feel that you lack financial literacy and knowledge of investment strategies, I suggest you subscribe to my channel and write the word investments in the comments. I will send you a detailed guide on investments and an effective strategy with 3 ways to invest your money so that it generates passive income for you throughout your life, all for free. The money will truly start accumulating in your accounts, and you will have more of it. Check it out. Write investments in the comments and start learning.